how y'all doing this morning? For this talk, we're going to have Jacen be giving it. He is currently pursuing an MBA at SMU while building out an attack surface management program at a large critical infrastructure manufacturer. Prior to this role, he consulted various F100 companies on matters of strategy, communication, and consumer privacy as a member of a Big Four consulting firm. He started his cyber and information security program at a large investment bank where he ran their global social engineering program, application allow listing, and supervising approvals of all new applications with data leaving the bank's network immediately following his graduation from UNT with his BS in computer engineering certificate in cybersecurity. He's also running the red team for the Southwest region of the Collegiate Cyber Defense, which you gave talks about on THA. It's really good. But he's going to be talking about security's effect on the bottom line, corporate financial literacy for information security professionals, where he's going to discuss how information security professionals can better communicate with financial officers and C-level executives about what they're doing. Yeah. So I'll leave it over to you.
Thank you. Thank you, Trent. All right. Good morning, everyone. Thank you for coming out. What? What's up? We got buttons to push?
Oh, it's supposed to be black.
Oh, yeah, no, that's me.
Dave.
That's my slide. I start with a blank slide. Good morning. Thank you for coming out to what is probably the most boring talk, because we're going to be talking about accounting and finance and all that other stuff that most people think has absolutely nothing to do with cybersecurity, but we're going to try and weave it in there. Enough of you are here that I assume you're interested. I assume you all know which talk you're here for, right? Okay, cool. All right, cool. Well, thanks for being here. I appreciate it. We're going to talk about financial statements and why they're important to us and what we do, specifically as technical risk managers and how that applies to the business at large. All right, some disclaimers. None of this is related to my employer. This is all stuff that I'm doing on my own. All thoughts and ideas are my own unless otherwise stated. I'm not a lawyer. I'm specifically not your lawyer. This is not legal advice. I am not a doctor. I'm not your doctor. This is not medical advice. I'm also definitively not a financial advisor. This is not financial advice at all. This is just things I know that I've learned from my education. And I think it's silly that people have to pay 6 figures to go learn this stuff when it should be. It's not hard. It's just not well presented in most places, I don't think. So I'm trying to bridge that gap so you don't have to go get an MBA yourself. An overview of what we're going to be talking about today. We've got the introduction. I'll tell you a little bit about who I am, why financial statements exist in the first place, why they're important, how they came to be, the different types of the financial statements, which are conveniently listed here. We'll continue on, and then we'll go through some examples and some applications and then summarize. So who am I and why do I have the knowledge to talk about this? Well, first and foremost, I decided that to move up my career, I needed to get an MBA, and so I went and signed up for one. And so this is kind of a summary of things I'm learning in the first semester. Other than that, formal education, I am currently the Vulnerability Management Program Manager at a critical infrastructure manufacturer. We do full spectrum there, from automated vulnerability assessments to physical breaking and entering and everything in between. So if you want to talk about that, come find me and I'll talk your ear off forever. Prior to that, I was a senior cybersecurity consultant at a Big Four consulting where I did a little bit of everything. We did some broad strategy for the CISO and board of directors. We did some communication plans. We did some pseudonymization and things like that, which is a fun word I learned to spell for the first time there. Before that, I was a cybersecurity analyst at a large investment bank where I ran their global social engineering program. So basically, I did the phishing for everyone here in the US, South America, Europe, Japan, Hong Kong, everywhere, you name it. That was a blast, learned a ton. I also ran their external digital activities work group, where every time they had a new program that had data leaving the firm, I ran the work group that did the approvals for that. And I did a bunch of other things here and there, like application allow listings, some SAST analysis, and things like that. And prior to that, I got my education at University of North Texas, where I got my bachelor's in science in computer engineering. I chose computer engineering over computer science or IT because I thought engineering meant more money. I was wrong. It just meant more math. Took some classes here, too. funny enough. Actually sat in this auditorium for Digital Logic. Good times. Let's see, while I was at UNT, I ran a team of student researchers doing a project for NASA where we revamped their DHCP protocols for spacecraft. As far as I know, that's in the process of being put into implementation, but it's going to take a couple of years to get new hardware up there because that was one of the key requirements we came up with. I also ran the Student Club for Cybersecurity and Intelligence while I was there. Yeah. All right, enough about me. Why do we have financial statements? What are they? How do they come to be? In short, people were cooking the books, and that's what led to the Wall Street. Yeah. Led to the Wall Street financial crisis. Kicked off the Great Depression. A lot of people decided that was a bad thing, and we shouldn't do that again. And to not do that again, we needed to make sure that people weren't manipulating their financial statements. So a bunch of things kicked off, and a bunch of laws were passed, and ultimately, that came out to be the U.S. Securities and Exchange Commission, which puts out a lot of the guidance for these financial statements. There's a bunch of other laws that were passed that goes in this. One key thing, 1994, they launched EDGAR, which is a online platform with an API and stuff. So if you want to go pull these things in an automated fashion, we're going to talk about that a little bit later in the talk. And then most recently, Sarbanes-Oxley Act. So for those of you in GRC, you are probably way more familiar with that than I am. This is just kind of a summary of timeline of how we got to where we are today. Financial statements and their, I'm going to say rigidity, don't change very often. There was, I think the most recent change was 2002, if I recall correctly, for what has to be put out there. There's other things that change a little bit more frequently, but we'll get into some of that. Other stuff is way beyond my knowledge because I am just starting, and I'll be back next year with more maybe. Who knows? Depends on how much y'all like this. All right, financial statement types. So the United States Security and Exchange Commissions, I need to be specific about that because there are other security and exchange commissions out there from other nations. There's a couple of requirements. A lot of that depends on size of the company and the type of company, but basically anyone that's publicly traded, if you can find a stock ticker for them, they are required to put these out. Specifically the 10K and the 10Q. The K is their annual statement, which is a summary for the calendar year previous, and the Q is for the previous quarter. Important to note here, not every company is on what we call the same fiscal year, which means that 10K, that annual report, doesn't come out January 1st for every company. A lot of them do. Some of them have their fiscal year starting what the rest of us call Q3. So I think it's July 1st. Okay, February, March, April, May, June, July, yeah, July 1st is when their fiscal year starts. So we're gonna see that in one of the examples later on, where one of the companies puts out their 10K for their annual report in July, whereas others put them out in January. Typically, it has to be on the quarter of the year, which is every 3 months, the first of the third month in that cycle. It's up to the company of when they post that. I've not found any good reasoning as to why they shift those around. I'm sure there's a reason. I don't know what it is. Yes?
So when I worked for a retailer,
Yeah.
our financial year was essentially February 1st to end of January.
February, okay.
Now, the reason for that was it made a lot of business sense because retail Super Bowl is Thanksgiving, Christmas,
Yeah,
right?
yeah.
We did not want our major purchasing season to be at the very end of our financial year because it would have been hell to close.
Yeah, that makes sense.
There's usually a strategic reason why it's been.
That absolutely makes sense. Me being in critical manufacturing for heavy manufacturing, that's less of an issue. But that absolutely makes sense. Being on depending on the vertical you'd be in, it would determine when you would want that fiscal year to end. The three main documents that are contained in these reports. Now, there's a bunch of other stuff, but the three main ones that we're going to be talking about today are the balance sheet, the statement of income, and the cash flow statement. And those are the three that kind of tell you what the company has been up to. Oop, not yet. Slow down. There we go. Most of these here in the U.S., any company that files in the U.S. with the SEC, U.S. SEC, is going to be following what we call GAAP procedures, and that's generally acceptable accounting principles. And that's put out by an organization that basically makes sure that everyone's kind of doing the same things as they're putting together these documents. That's important to note because as we move from company to company, vertical to vertical, retail to manufacturing, there's going to be very different ways of doing business. So some things make sense to be recorded in different places depending on your type of business. So accountants and people in finance have a decent amount of leeway with where they record their expenses and when they record their expenses. These are just general principles that apply to it. We're going to go into some of these. For example, you recognize revenue when the service is provided, not necessarily when the cash comes in, things like that. If you're going international with other companies that are based overseas, like maybe a Volkswagen or an Audi, you're going to go with the international requirements. That's from an organization based out of London. We're not going to be talking a whole lot about that. We'll talk a little bit about GAAP as we go on. You will notice in a lot of these financial statements, in addition to the GAAP documents that are required, a lot of the companies will provide non-GAAP numbers, which are things that are not in these generally acceptable principles, but they feel like are better representative of their company. So they provide the numbers that are required in the way that's required, but they also do an additional bit of information that they think is more representative. The issue you run into there is not everybody does those the same way, so it's hard to apples and oranges, that kind of thing. All right, about the balance sheet. This is the financial position of the company at a single point in time. And so it's going to be very interesting. We're going to talk about these three documents. Some of them are point in time, some of them are over a period of time. And what this balance sheet does is it basically says, this is roughly what the company is worth. These are all the things we own, these are all the things we owe, and then here's the extra that belongs to the shareholders. And we call those assets, liabilities, and equity. So the assets are the things that the company has, things like cash, or investments, or inventory, and accounts receivable, things like that. Liabilities are things the company owns, like accounts payable, taxes, things like that. The equity is kind of the balance, the middle, that is the value of that belongs to the shareholders. And it's called the balance sheet because it balances. There's a really easy formula there where all of your assets must equal all of your liabilities plus your equity. And you can flip that around, do your basic algebra however you want. But when we look at a few balance sheets, that's how that's going to look. And so actually, if I'm going to bring up Microsoft's 10K. Can I do this? This is going to be hard. Okay, so I don't know how to make it bigger. Nope. Yep. Hey, all right, there we go. So this is Microsoft's 10K from 2023. This is their financial, I believe Microsoft is one of the ones that ends in July. I can go to the top, we'll find out later. But you can see here they've got all of their assets. Something to note is it's separated between current assets and non-current assets. The big things there are current assets are things that were either acquired or intended to be sold within the next calendar year. Non-current assets go longer. So if you buy a big old manufacturing facility, you're going to keep that a little longer than a year, hopefully, otherwise it may not be the best investment. So that would be called a non-current asset. If you're going to buy a couple pallets of lumber, you probably want to turn those around faster than a year, so that would be a current asset. Probably under inventory depending on your type of business you're running. That's just a quick summary of what you're going to see up there. We're going to go into a lot of this more in detail. Let's see. Things go on the balance sheet only if they have a perceived future benefit. And sometimes as markets change, so for example, if I bought a manufacturing facility 2 years ago, 4 years ago, let's say, the value of that real estate's probably gone up since then, but we don't reflect that in the balance sheet. We reflect it at its initial purchase price. The only time we would take that into account is if we were to sell that facility, and then that would go into the cash flow statement and income statement later on. Let's see here. Quick summary. We're not going to go into a lot of detail there, but let's look at the next one, which is the income statement. If my mouse will work. Come on. There we go. All right, income statements they show profit or loss over the period of the time, and that could be the year or the quarter, depending on that statement they come out of. And these cover three main categories. That would be revenue, the cost of revenue, and other expenses. So this is basically how the company conducts itself and makes money. Revenue is the things they sell, the services they sell. And it's important to note that there's a cost to that revenue. So if I am let's say I build houses. I'm a general contractor for construction, I build houses. When I sell you a house, that doesn't come free to me. It doesn't poof out of thin air. I have to hire labor to build it. I've got to buy materials to put it together. There's, what's the thing where you pay a city for a license? Permits, thank you. Yeah, you got to buy the land. There is an expense to produce that thing that I sold. So it's not pure revenue. And that's what we call cost of goods sold, things that go directly into that. Important to note, if I'm a real estate agent and I have a cybersecurity team because I'm that big, I don't know, that cybersecurity team doesn't directly contribute to the cost of the revenue or the revenue itself. So it's going to go into other expenses. Things that go into cost of revenue are explicitly, you can point to that thing and say, yes, that went to make this thing, if that makes sense. So HR wouldn't fall under there. Your accounting team wouldn't fall under there.
So services.
Yeah, exactly. Some other simple math, revenue minus expenses plus gains minus losses is your net income revenue. It's important to note that most of these financial statements for publicly traded companies are on the accrual basis, not the cash basis. So when I do my personal budget at home, I use more of a cash basis, right? I get paid, that gets logged immediately. I pay my rent, that gets logged immediately. I got my car payment, that's logged immediately. Accrual basis is more when the expense is generated and when the income is recorded for the services provided. So when we, for example, back on the general contractor, if I sell that house for, I don't know, let's go back to the 90s, $100,000. I don't mark that as income on the accrual basis until the sale closes. Even if the money transfers a month before, accrual basis says I have not earned that income until the sale closes. It's the same thing for a car, right? If you send money to the dealership a week before because you know you're going to get it, but say you're on vacation, you can't pick it up right away, they don't mark that as income until you take delivery of the vehicle. This can get complicated when you're talking about things like consulting or other services where it's spread out over time, where I sell you 2 years of consulting services. I can't mark that all now as income. Even if you pay it all up front, I have to mark it as income as the services are provided. And that goes back to the generally acceptable practices, generally acceptable accounting principles that we talked about earlier, that gap, where do I take that the first year all up front? Do I take it month by month? It really depends. And so that goes back to depending on your industry, and that goes back to where the accountants have some leeway of when they mark that income as revenue generated. Otherwise, it goes into another account we call unearned revenue, and that's cash that we have received but we have not earned yet. And so because we have not earned it yet, that's technically a liability. That's a thing that we might have to pay back. That's the biggest note there. Any questions on cash flow?
Is this, like, I might be going too far, is that where, like, CapEx versus OpEx comes in? Like, how much?
Yeah, so that's a fantastic question. That is more, that gets complicated. Yes, so yes, because there are some companies that will, what we call capitalize certain salaries. And what that does is that allows them to realize that expense over a longer period of time. So for example, I heard a story about a company that capitalized their salaries of their developers, their coders. And they would realize that expense over a period of 4 or 5 years. And that made the books look really, really good because they weren't spending a year's worth of salary in a year, they were spending it over 5 years. And so that CIO would come in, capitalize their developers, books look amazing, and then right at the 5-year mark when all that stuff starts to hit, they bail and they go to another job. And it looks like they did an amazing job, and whoever comes in has to clean it up. Whereas operational expenses are things we're spending on, things we're doing right now, which should be most salaries, or things that go into it. So for example, when I buy a tool, we talked about how I do vulnerability management and attack surface management. When I purchase a tool from a vendor, that is technically an operational expense, at least the way my company does it. Other things like when we get into manufacturing facilities, like real estate, warehouses, equipment, that is more of a capital investment, and that gets put on the books as it depreciates. So for example, when you buy a car, that car is not going to last you forever. There's a really good chance that wear and tear, it's going to have a lifespan of, I don't know, let's say 10 years, depending on the car. And so at that point, you put the cash out right away to buy the car, let's say $10,000 on the car, and then at that point you would depreciate the car's value by $1,000 every year, and you would mark that as that expense, and that would be a capitalized expense. Does that make a lot more sense? We're getting into way more complicated things than I was anticipating getting here, but that is a fantastic question. Yeah. Yeah, and I'm glad you asked it, because looking back, I should have put this in the slides, because that's probably the one thing that affects us the most, is how a company manages our salaries. Are we capitalized salaries, or are we operational? In my opinion.
Like just trying to maintain the operations, like is it cheaper to swap it, like just kill the server and move to the cloud?
Yep.
Or to actually upgrade it, depending on how they're.
Yeah, absolutely. Again, we've got some simple formulas for how this statement balances. And the three main categories in here are operations, financing, and investing. So operations are things we talked about just now, like salary, buying a manufacturing facility. Financing is, how do we raise the money to buy that? Do we have cash on hand that we can do that? Do we need to sell common stock? Or do we go get a loan for it? Investing could be other things. A lot of companies will invest in marketable securities in the same way that you and I do, and that could be just a matter of hedging against future expenses. All right, so let's dig in a little bit more. How do you compare two different companies that might be in a similar category but different sizes? So I'll provide the slides. You don't need to take pictures unless you really want to. How do you compare, say, Microsoft and Amazon, right? Both have cloud services. Both have some form of, let's say, consumer sales, right? I can go buy a copy of Windows 11. I can buy anything off of Amazon. How do you compare the two, right? And that's why we come up with the concept of ratios, where when we do some math with the same numbers that are in every one of these reports, we can kind of do some comparisons about what is the return on equity. So of the shareholder equity that is in that company, how well is that company using that equity? We got return on assets, the things that they already own, how well are they doing that? We can get into leverage, and that is basically what is the risk with the company presently? Are they over leveraged? Do they have, how's their liquidity and their solvency? And those terms mean liquidity when they go to invest in something, they go buy a new facility. Are they likely to use cash, or are they likely to take a loan? Solvency is what is the likelihood of the company continuing to function based on its existing finances. How risky is it for me to give them a loan? So we're going to go into all of those, and this is I took out that slide. All right, so the first one, this is the DuPont ratio set up, basically three big ratios that you can go crunch. We can take out of these three documents. I want to point out something really interesting here. I've always found this fascinating with ratios. You've got one document, the balance sheet, which is point in time, and you've got other documents which are over a period of time. And we are taking facets of both of those things from different time factors, right? Things that are now, or yesterday, or point in time, versus things over the course of the last year. We are taking aspects of both of those and combining them to make ratios to compare different companies. Return on equity is a big one. We got return on assets. How effective are they using their assets? Total leverage, which is how do I explain leverage? How much are they borrowing? Are they borrowing more? What gets into some of the risk? Yeah. Yeah, and I will be posting these slides, so you don't need to write all this down if you're interested in it. But here's a bunch more ratios that talk about profitability. That is, how effectively is the company generating revenue based on these things. So there's some stuff to talk about based on their dividends. How effective is their revenue? How quickly are they growing? And sustainable growth is really interesting because that tells us, based on the growth the company is doing, Do they need to expand their properties and equipment? Or is that a slower thing? Because when you look at that sustainable growth ratio, that can tell you, does the company need to make more investments in the future to continue its expansion, or are they going to stagnate or over leverage themselves? We get into some big ones here like gross profit margin and operating profit margin, and that's basically literally the profitability of the company. It tells you how effective they are at generating revenue. We got some asset management ratios. That just tells us how well are they using the things that they have. So the property and equipment that they have, how effective is that being used? How effective is inventory being used? Inventory turnover and on-hand period is fun because that tells us a little bit about how quickly they go from making a thing that they sell to selling it. And then there's more that gets into later about how effective are they about managing their finances, about collecting money from customers that they've sold to, and how effective are they at paying vendors that they bought supplies from. Those two are really interesting because everything else we say we want to maximize, right? We want to maximize return on investment. We want to maximize return on equity. We want to maximize return in sales. However, for your cash collection period, that is how good you are at getting money from your customers, and for your payment period, that is when you pay your vendors, those are things we say we want to optimize, not necessarily maximize. And the reason why there is because if you maximize the amount of time that your customers are paying you, that's going to impact your cash flow statement because you're not getting your money soon enough. At the same time, if you shrink it down and you give them, this gets into net 30, net 60, net 90. The idea being that a customer places an order, you ship them the product, they have 30 days to pay you. And this is where we get into optimization because depending on those terms, the net 30, the net 90, a customer might be willing to pay more for longer terms. But if you charge, payment on delivery, they might not be willing to pay as much. In the same way, when we're talking about suppliers, if we're paying them quickly, we might get better pricing. If we're requiring them to wait 90 days for us to pay them, we're going to have easier access to cash because we're not pushing out as fast, but that supplier might not be willing to give us the best price. Does that make sense? And so that gets into a whole other thing about cost of money. So when I want to go invest in a new manufacturing facility, do I have that cash on hand because I've optimized my accounts payable and my accounts receivable, or do I need to go take a loan and then incur interest charges in the future? And that gets all very complicated very quickly. And here's some solvency ratios. They talk about what is the risk that the company is taking. And depending on your accountant, if you can tell certain things about how the company invests when they go purchase new materials or new facilities, do they do it with cash on hand or do they need to take loans? You can tell a lot of very interesting things from these numbers. All right, so I've blathered on for about 30 minutes about financial statements and ratios and whatnot. Let's take a look at a few. So I have already pulled the 10Ks from Microsoft, Google, and AWS from 2013 or 2023, and we're gonna pop those in real quick. So let's take a look. So let's take a look at Microsoft real quick. So if we go back up to the top, maybe. Wrong way. All right, so we can see here, this is published for the fiscal year of June 30th, 23. So we can see Microsoft is not on the calendar year for their fiscal year. And as to why, I can't speak to that. Do you have any insight on that one? No? This might just be part of being a technology company. I don't know. But as you can see, there's a lot of stuff in here that are not numbers. That's a lot of words with some numbers. And that's because part of each of these filings is what we call management's summary of the year and extra things. So they're going to talk about what happened, acquisitions, what's the word? Not spin-off, sell-off, the opposite of acquisition. Divestiture, thank you. So they're going to talk a lot about that. They're going to talk a lot about goals for the future, things like that. When we get to the actual balance sheet and statement of cash flow and income, realistically it's only about 3 pages, but you can see there's a lot more here.
Where's my $12 a month for my Office 365?
Right? So and that's interesting because there's, generally speaking, there's a section in it that talks about how they do their business and how they generate their sales. And they'll say, yeah, licensing for Office products, licensing for operating systems, cloud income because they're going to be running Azure. What's really annoying about a lot of these things is you're not going to see a lot of those broken down here. Some of them will, some of them won't. Companies fight really hard about trying to put that information out here. So it's going to be really hard for me to determine how much of Microsoft's revenue is from operating systems versus Azure. They're not going to share that with me. So we're not going to get that.
That specifically, it's in there and it's interesting. All their money's from Azure. Windows is part of Xbox and other crap. Windows is like literally other crap. And Azure is like all other crap.
That actually makes a lot of sense. All right, so here's the income statement. You can see we've got revenue. And it's important to note when reading these, the sum for the category is at the bottom. So for this first 2 lines, we see revenue, product, and services and others. So we've got a dollar amount for product, we've got a dollar amount for services and others, and then we've got total revenue for the line. So there's the sum of the 2 on top. It's important to note that because when you're looking for the bottom line, you're not going to sum everything in that column. You want to sum the right things, right? You want to add the right things because otherwise you're going to get duplicates. So be aware of that. Fortunately, they already do most of that for you. Let's see here. So we've got the income, the revenue from their services and products, and we've got the cost of revenues. Now, this is really nice. They broke it down by products and services. Products is probably an operating system. Services might be Office 365, might be Azure. There's a lot of different things. Also important to note, these are usually, especially for the larger companies, these are in millions of dollars. They did not make $211,000 last year, just to be clear. So keep that in mind. There will be a statement somewhere in the bigger document that says what these units are in. All right, so we've got operating income, gross profit margin, total cost of revenue, and net income, which is the bottom line for this. They do a little extra here, which is earnings per share, and that gets into a little bit of equity. This is also an important ratio. It's basically saying that of all the common shares that Microsoft has issued, this is how effectively they're being used. So if you are a shareholder with Microsoft and you have 1 single share, you made almost $10. You don't get to see that, right? It'll come out as dividends, which is probably pennies on that, but it varies company by company. All right, moving on. Here is an income statement, sometimes called comprehensive income statement. Net income, other, comprehensive. And I think there's a little more detail on the next page. For this one. Nope, we go straight to balance sheet. All right, so there's your assets. These are all the things they own. And then we've got a summary of current assets, total current assets. That's the things they've made and plan to sell this year or the things they've purchased this year. Things that are intended to rotate out within the calendar year. Then we move on to total. Goodwill's a fun one. That's basically leftover value that they think from a company they've purchased. So for example, back when Google purchased Android, or YouTube for that matter, they absorbed all the revenues and income and expenses, and those get reflected in all those other categories. But goodwill is what they feel like represents the value of the brand itself of YouTube. So if they wanted to sell off the brand of YouTube and just rename it internally, that's a thing they could do, and that's where that would value. Intangibles, that's typically patents, things like that, and that's typically only logged as they purchase them. When they go make them themselves, that's generally speaking part of operation expenses. So that's a balance sheet. So that's the assets anyway. Yeah, liabilities and stockholders' equity, they like to put these together because it's the balance of the assets. Remember, assets equals liabilities plus equity. How am I in time? Oh, we're good. We're good. Again, you've got it broken down by current, which is things for this year, and then total, which is all of them. And then equity is just what's left over. It's after you, if Microsoft was to, you know, make an announcement today saying they are going out of business, and they sold off all their property and whatever remaining licenses they have and whatever physical servers they have, and they paid off all their debts, that is the liabilities, equity is what they believe they would have left over that would go to the shareholders. All right, I think that's all three. Did we cover all three? Oh no, cash flow, here we go. Okay, here we go. Income from operations is basically how they break down what they did, the functions of the business directly to generate income. Something worth noting, parentheses is an accounting way of saying a negative number. So whenever you see a parenthesis in an accounting statement, that's a negative. So you would subtract that when you add it together. There's your financing section, and so you can see here there's stock issued, stock repurchased, dividends paid out, and that's the total that they spent on financing. Yes?
So, like, as we're moving into subscription economy, like, I can just, like, when you watch Shark Tank, we'll always ask, how many users do you have? That user number will be an exponential number on how much you want to actually charge for the service at the end of the day. So if you have 5,000 users of Microsoft Office, is that marked as, like, you have 5,000 at $10 and that's the number? Or do they change the price of the subscription all the time? How do they quantify your user base? Now that subscription economy is one of the main drivers of a lot of things.
That's a fantastic question. I don't know I can't like speak authoritatively on that. Based on what I know, I think that they would do that on the back end. That's like all the extra things that we don't get to see as the public. In the same way that your employer has a lot of different ways of accounting for all the different.
Just like the regular thing.
Right. Yes, it would filter into the services and products that we saw earlier in cash flow. Does that make sense?
And the value that's derived from that is something that we're never recommend.
Yeah, that goes back to what I was saying about there's no way that I'm going to be able to determine from these statements how much of this was from Windows 11 versus how much was from Azure subscriptions. But yes. Yeah, pretty much. All right, next one is investing. Pretty straightforward here. This is just things they've purchased for investing. Some income's there for sales of investment and as investments mature. What those actually are is going to vary from company to company. Sometimes you will see those details in the statement from management earlier in the what do you call it? In the statement. I've also got Amazon and Google pulled up here. Yo.
What about for the people who have finance folks that really love to run around and scream the words, EBITDA, EBITDA?
What exactly is your question?
That's okay. So just for those folks, it's like, what is EBITDA? Why is it important?
So yeah, EBITDA or EBITDA, depending on how you pronounce it, is earnings before debt, interest, taxes, and something else. Amortization, yes. And that gets into what is the difference between amortization and depreciation, which is, we talked about that a little bit about the car purchase example about how you capitalize expenses. Amortization is the equivalent for intangible assets. Essentially, it's just another ratio that you can use to evaluate a company. There's the truncated version, which is just EBIT, which is earnings before interest and tax, which a lot of people think is a more accurate representation of the company, because if you do it before debt and amortization, that can be a pretty sizable chunk depending on the company you're looking at, and so it might not be as realistic. As to why people are pushing that, I don't know. That is a ratio that was presented to me in my class. So, and my understanding is there's some legislation floating around that may push certain industries to that. I've not followed up on that one. Is that what you know?
I don't know.
Okay.
I do know the SEC basically says if
I mean, that's fair. If you're going to use a non-GAAP metric, you need to tell us how you did it. Yeah. So here's Amazon. Yep, Amazon, all their numbers, yada, yada. We're not going to go through them all just like that, but here's Google as well. So what I have done is I have already taken these numbers and I've put them in a spreadsheet. Blah. Where's my mouse? There we go. Because we all know everything in cybersecurity runs in Excel, and it's even worse in accounting. All right, so that is really hard to read. Let's see what we can do about that. That's not working. We're going to do that. Okay. All right, so not every line in the statements goes into these ratios. I've pulled out the key ones that we're going to be using, and I've already copied in the numbers. Fortunately, as weird as these statements are, and as much as they are different between companies, most of them use the same terminology. So it's not too hard to go into. Wait, what does that say? 5? Trent? Oh yeah, you're right. I can't do math. All right, we're gonna be quick then. All right, these are numbers for Microsoft, Google, and Amazon that I've already put in here. These are the applicable lines from their statements to the ratios that I showed earlier. And I've got a fancy little Excel thingy here that calculates those ratios for you. Oh my, we can't read that either. All right. I got 5 minutes, so we're gonna be quick. You can come talk to me afterwards. I will be posting this on GitHub, so if you wanna come talk more and explore my ignorance, we can do that. Ratios, ROE, return on shareholder equity. We can see here from these numbers that were calculated for Microsoft, Google, and Amazon, we can see that of the three of them, Microsoft is more effective at using the equity that the shareholders have put in to generate revenue. And that's because their ratio is almost double what Google's is, and definitely bigger than Amazon's. I don't know why it says AWS, I should say AMZN. We'll fix that before I post it. Return on assets, that is how effectively the company is using the assets they already have. Looks like in this case, Google's using their assets more effectively. And for leverage, that is how much they have borrowed versus their income, we can see here that Google, Amazon has borrowed more than the others. Significantly more than Google. And so you can kind of get a little bit of insight based on their existing leverage. How are they going to finance future investments? Can they afford to make future investments? And this gets back into the growth and sustainable growth. If a company is growing exponentially and they're already over leveraged, that sustainable growth is going to look really bad because they're not going to be able to afford to invest to maintain the growth. All right, let's get back to slides because I got to be done in 2 minutes. Blah, blah, blah. Hope you learned something there. Edgar is a electronic data gathering, analysis, and retrieval system. They have an API and a Python module that the SEC maintains, so you can go pull all these numbers. It's really cool. I'm playing with some automation stuff on there with some of my classmates. Fascinating stuff. Impact. I got 1 minute to talk about impact. Okay, so most people, if you're in an internal cybersecurity team, unless you work for a vendor or a consulting company offering cyber services, you are not going to have impact of the purchase of raw materials or the sales, right? Most of us are expense lines to the company. We don't go into the operating profit margin, we go into the other. So how can you impact these lines if you cannot change sales and purchase of raw materials? Prevention of incidents, right? So Bill just talked about triage and how to reduce the impact of an incident. Incidents have real life cost implications to a company. And that could be just from the breach itself, that could be from ransomware leading to a larger impact. So the more breaches and incidents we can prevent, the more we can save the company from having to put cash out, because that's where that's going to come from. That's going to come from that cash line on the income statement. Reduction of costs, the better you can do to negotiate better prices for cost and services from your vendors and consultants, the better off your line's going to be. And then timing. So if you can push out that payment to the investor, that has the push out the payment to the vendor, that has the ability to impact the cash flow statements, and that might give your company access to cash to make those investments without having to borrow and incur interest expenses. That being said, it might impact your ability to reduce costs. So balance all those, work with your finance team, they'll have input for you. Sources, blah, 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 classes. That's the book I read for class. Highly recommend, really great, not super technical. I binged it in an audiobook format in about a day. Really straightforward, really easy. Y'all are smart. I know you are because you're here. You'll be okay with that book. That class, Securities and Exchange Commission, is a fantastic website with a lot of resources. Wikipedia is great. Also highly recommend Investopedia. Summary, blah, blah, blah. These are the things we talked about. We're out of time. I'm over time. This is how you get in touch with me if you have additional questions. I'm sorry I am out of time, so I can't take more questions, but I'll be here all day.